Hey everybody, it's Michael Martin. Hope you're doing well. Thanks for being here. Happy Monday. So a good question came in from YouTube about, what are my thoughts about hedging versus taking a loss? And this is a deep question. And I think the way the question is asked is, you're in a position and it's gone against you. And now the pain of losing money has put you in a spot where you want to try to hedge away the risk of further downside. So to me, that's an emotional issue, not a financial one. And it means to me that it hasn't been worked out ahead of time where you're comfortable putting on the risk, but at the same time knowing where you're going to get out. Pro traders know both of those numbers, those price points. They obviously know the quantity too, which is kind of where we make and lose all our money is with position sizing more than snipering your entries. But it certainly sounds like you're a Navy SEAL or something. But it's not. Again, you need relative accuracy to make money long term here. There's an old saying, I don't know who came up with it, and it says something along the lines. It goes down as one of those Chinese proverbs. I don't know if it's a Chinese proverb or not, but ultimately it's kind of in that Pepperidge Farm commercial kind of wisdom. And the saying is like, if you're out in the water and you're in a boat and the boat springs a leak, you don't drill a hole in the boat at that time to let the water out. And if you can understand why, if you're already losing money, you've already missed the time to hedge, right? Hedging happens at the beginning. In order to have an effective hedge, you have to have correlation. I can't hedge. I think it was Gundlach or somebody was talking about having a long Apple position and short natural gas or something. And there's no real connection there between those instruments. So in order to have a hedge, you have to have correlation. Spreads in commodities are hedges. That could be like what options traders would consider time, right? Or horizontal spreads is really what you would do in futures, buy 1 month and sell another month against it. That would be an intra-commodity spread. Spreads are hedges in commodities. You can have an inter-commodity, meaning between two different ones, gold, silver, stuff like that. But those relationships to me are kind of just historical. I don't know that there's trading signals around them. I'm sure there's one person somewhere, though, who can do it. And so, more power to you. In terms of stocks, you can have pairs trading in equities where you're long at one instrument in a sector, normally the strongest horse in the barn, and then you're going to sell short the glue factory one. Julian Robertson of Tiger Management was famous for doing that. So you're kind of in the sector. So it's not a perfect hedge, but it kind of means if there's sector rotation or if the sector gets hit from reallocating money, at least you'll be short a name in the sector to kind of offset the losses that you took on your long. So this brings into the sharp relief now the concept of options as a hedge. So if you're long a stock, how do you hedge? Well, hedging, you want to be in control of the instrument that you're using to hedge, right? So selling calls to me is not really a hedge. It's an income creating strategy. Why? Well, say you buy a stock at 50 and you sell a $5 call, you're capping your upside for one, which I typically don't advise doing. And two, the hedge, what happens if the thing opens at 30? How effective was your hedge, right? You lost $20 on the stock and the premium on the option probably got cut to $3 or something like that if there's any time value left. So that's an imperfect hedge. I know on the Series 7, which we'll talk about sometime this week, and they talk about hedging. But if you're not in control of the option because you've sold it short, to me, that's not an effective hedge. When you buy insurance, you're in control of the policy, right? So now you're talking about basically married puts. And married puts is a situation where you're long a stock and concurrently long a put on that underlying instrument, right? At a strike price, that makes sense. Again, if you have a $50 stock and that's your cost basis, buying a $20 put, what's the point, right? So, and insurance costs money, so it comes against performance. What you eventually have, though, in that standpoint is a synthetic call, right? So you say, well, why don't you just buy the calls up front? So that's why this is a very complicated question, because it's like, is it financial or is it emotional? My first impression is that it's an emotional. aspect. You've lost money. You've put a lot of time into studying this name. You might have long-term beliefs. The best thing to do is to trade it smaller. If you're going to be worried about how much you're going to lose on the name, then cut the position in half and step in. I kind of did that not for the same reason, but because when I was wrong, oftentimes that was early. And I couldn't stay in the position with the full position on, so I couldn't put my optimal position on at the same time. And I didn't want to hedge. Because think about it. If you buy a stock at 50 and you buy a $5 put with it, right? So your costs are 55 a share. Your break even is higher, right? On the whole thing in terms of making money. And if you're really thinking about holding it for a long period of time, kind of like maybe not as an investor, but as a position trader, more like me, then what I would do is I would scale down, trade it smaller, and step into smaller pieces and add your way up to your optimal size. This way you won't have reluctance to take losses. But, to give you the advice that I think you're soliciting, I would have the requisite amount of shares that are appropriate for the amount of risk that I'm willing to take. Right? That's the key here, willingness. And then knowing exactly where your exit is. That to me is the best thing to do as far as managing the risk. Because normally when I hear about, especially since you said taking a loss versus hedging, you hedge at the beginning. So that would be something that you would do, or you'd walk into that trade knowing ahead of time. But again, I don't know too many traders that are doing these types of things unless it's a longer term hold, right? So it wouldn't be a swing trading or a day trading type of strategy. And if you wanted to be in the position for a longer period of time, my advice would be to not get the married put, but to trade the actual instrument smaller, right? And then see how it behaves. This way you give yourself a lot of latitude. And if it works against you, it's not going to do any lasting damage to your equity. Also, I'd have a firmer understanding of, where's the reluctance coming from, right? Because that's going to keep showing up, and it's probably showing up in other parts of your life too. Why? Well, because we run emotional systems concurrent with what we think we know we're doing in the markets, which we typically don't. We're kind of dealing with probabilistic outcomes, and hopefully we can skew the odds in our favor enough times so that even though we might lose more times than we win, we still make money. So I would get used to the concept of expected values and the expected value of a trade and what that means to you, and reconcile the frequency with which you lose. Once you get comfortable with that, I think you're going to lose the need for having a hedge. Doing that and also trading it smaller is probably more prudent risk management. And if you're saying to yourself, well, then I'm not going to have enough on to make money, well, then you got to sit down and look yourself in the mirror and figure out, what are you doing this for? Because at the end of the day, if you know the expected value of a trade, you can figure out how many trades you have to put on in order to hit your target, right? Because you're not just winging this. You have a goal in mind, right? A financial goal in mind. You know why you're doing the trading in the first place. What does it mean to you as a person, right? Because it can have emotional, psychological benefits and challenges, of course, as well as financial ones. So I wouldn't, when I hear hedging, again, if you're not normally a spreads trader, which there are, especially in the commodity space, there are people who that's all they do. And when there was a floor, it was one way that floor traders and market makers could hedge their risk, because market makers typically are inherently short. Futures are a little different because I don't have to borrow anything. I could just sell short. Everything in futures looks like a naked short to a stock short seller. There's no borrow mechanism here. It's not how that market's built. So to me, I would spend more time thinking about yourself more than the tactics of it. Married puts with stock, to me, I guess you could do it with futures too, only you know what's appropriate for your tolerance for risk and otherwise. But when I hear about married puts, it's normally something that they're doing at the same time. In other words, the put buying and the equity long are executed concurrently. If it's after the fact, to me, it's an emotional issue, right? Or it's a longer-term investment that, you're just not willing to sit through the loss. And so again, to me, I would work those issues out long before I even put the risk on, so that I have a set plan and I know where my ouch point is. It's probably worth noting here that I don't agree with the statement that says never let, a trade become an investment. I think if you're in a winning trade and it's working, to me, in the way my mind works, I would keep that winning trade for as long as possible, even if that meant a year, which kind of puts it into the investment category. Now, that's not my intention, right? But I have no power over the marketplace. And if I'm long an instrument and it just keeps going up, sometimes you get lucky and your trailing stop never gets hit, and you adjust your protective stop, you stagger it up, and the name really keeps moving and doesn't take a break. Sometimes that can happen for 18 months where there's no material pullback. There are other moves, like gold in the late 70s, early 80s, where there was zigging and zagging, so you had to kind of trade around the core position, right? But you don't want, of course, a losing trade to become an investment. So you need to know, if you're a trader, where your ouch point is, obviously, and get out, more than worry about hedging. The hedging part, to me, means you normally have risk. You can't take the downside. Maybe there's, again, this is talking about trading, but oftentimes folks who have concentrated positions because they have stock that they were awarded through a compensation plan, or stock that they've inherited, even with a stepped-up basis, they have an emotional attachment to it because their dad worked at Procter and Gamble and he's got a $10 million share position that you're reluctant to get out of because of the connection to your father. That happens all the time. I've seen it a million times. And there's still ways to hedge that, right? Look up, so with people who have positions that are, normally 2 million or more, you can effectively hedge and borrow money against that without getting a tax bill. It's a very sophisticated situation. The sophisticated name for it is a variable prepaid forward sale. The IRS currently does not consider that a constructive sale. I'm sure I did a video of it once in a while. So again, but that's for folks who have big stock positions with a low basis, where say 90, 95 or more % of the actual value is unrealized capital gains. So as soon as you sell a share, there's a big tax burden, right? So folks you can't convert stock in commodity speculation into the same as real estate, right? Where you can have cash flow, but the depreciation doesn't give you a tax bill. So folks would, use these. I actually don't want to get into it because it's not appropriate for most people. It's a private banking tool. And again, it goes into the realm of investing more. It's about holding that position for the upside, right? And then they hedge with using a zero-cost collar. And then you can borrow against a very creditworthy asset. If that's an issue for you, then reach out. We can talk about it, and where I can send you to have that done if you have a big concentrated position and you're worried about the downside. So how do you manage the risk there? Typically, you want to decrease the size of your position. But again, if you have enormous amount of unrealized capital gains exposure, sometimes selling that stock is a big tax bill. So the tax bill and the reluctance to take the tax bill and have to pay it because you don't have the losses to offset the gains, people become reluctant. What happens? They sit in the position and then it goes down, and all of a sudden they don't have a tax problem anymore because all the gains are gone. So again, as far as this is concerned, I think where you're going, this is a question about your emotional constitution more than anything else. Anyway, though, if I haven't answered the question thoroughly enough, write back. And that's about it. Again, I don't think selling calls is a hedge. It's really a way to bring in income. So I would anticipate that this question deals with buying puts. But again, you would do that on the onset. You'd put that trade on concurrently with the equity, presumably the equity long, right? Obviously, if you were a short seller and you wanted to hedge at the same time, you would buy calls concurrently, right? Because then you're on both sides of the market. But then again, what's the point? So anyway, good question. If folks, if you haven't been here before, thanks for joining the show. I've been giving away the audiobook version of The Inner Voice of Trading, which you can get for free. Click the link below. And if anything on the show here has resonated with you, please like and subscribe. And as Ganja says, to click the bell so you'll get alerts every time we publish a new video. Thanks for being here. I'll see you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.